So it's kind of an interesting data point I came across in researching the show. From 2008 to 2013, only 12 S&P 500 companies on average split their stocks each year. And this is data coming from S&P Dow Jones indices. By comparison, in the 90s, an average of 64 companies in the S&P 500 split their stocks each year. In 1997, there were 102 total stock splits.
Wow. So they're proofs in the pudding. I mean, yeah.
And so I have a couple theories as to why stock splits are going down. Before I name any of them, Sean, do you have any guesses or any thoughts yourself?
When I peeked at yours, they're very good. But the other theory that I have is the Warren Buffett has become a huge part of just the American nexus and everything. And he's become increasingly influential in the last 20 years. I mean, all these books, and he's just everywhere, and he's basically a household name now. And another instance where he kind of said this is silly was tech companies in the early 2000s, and actually Coca-Cola too, they weren't expensing stock options on their income statements. They were giving millions of dollars to employees, but they weren't expensing them on income statements. And Buffett was like, that's silly. It's hard to calculate the value, I'll grant you, and that's fine.
But you need to account for it somehow.
But you need to account for it somehow. And not only did Coca-Cola, which he owns 9% of, do it, and that was actually the first S&P 500 company to expense stock options, I believe. If it wasn't the first, it was one of them. But he actually got his buddy Bill Gates to do it at Microsoft. They were the first big tech companies. So I would throw I couldn't prove it, but I would just throw out Buffett being part of the American nexus and his thoughts on the matter. He does not believe in share splitting. He wants long-term partner shareholders. I would throw that as a harebrained theory of mine.
Yeah. Okay, so a couple thoughts that I had on it. One of them, you look at the time frame that was cited, and I grabbed this from a Wall Street Journal article, but that 2008 to 2013 range, that's mid to post financial crisis, and so you might just see companies that are looking for...
They were doing reverse stock splits, more likely.
Yeah. You might just see companies wanting to stay stable and not really rock the boat with anything crazy on the corporate governance side. One of the other things, I think, to your point about technology, you have online discount brokers, which make building positions much cheaper.
Right.
And so... you look at some of the very expensive tech stocks right now, like like Google. If you want to buy one or two shares, right now you can do it and pay a $7 commission.
Right.
And it's not the expenses are not a huge portion
of
the overall transaction.
Flat, so it doesn't matter.
Right.
Yeah.
Whereas, maybe in the early 90s or so, the cost of making those types of trades and position building and dollar cost averaging was a little bit more expensive. The one other thing I think might be contributing, maybe not quite as much, is the widespread availability of fractional shares. And so the idea that people do not need to buy an entire share of Google.
Right.
There are a whole bunch of platforms out there where you can buy parts of a share of Google.
Wonders of modern technology.
Yeah. So those are some of the reasons I see. But I think largely companies are not they're not as tied up in the idea of making it as accessible to buy shares. And I think there's something to that idea of building more of this buy and hold holding company type approach. I mean, you see that's what Alphabet did, right?
Yeah.
I mean, that's kind of what they're moving towards. And there's a lot of Buffett influence there.